Welcome back to the Pro Ticker Podcast, your Tuesday morning edition, covering major financial magazine headlines, everyone.
Good morning. And yeah, if you were watching the markets yesterday, it really feels like, well, two completely different stories playing out, doesn't it?
It really does. You've got the big indexes, S&P 500, NASDAQ Composite, hitting these, fresh record highs. Just huge AI optimism driving things.
Absolutely. But then kind of underneath all that gloss, you've got global instability really bubbling up, regulatory pressures too. It's injecting a lot of volatility.
That exact whiplash is what we want to dig into
Yeah.
today. That's the mission for this deep dive, dissecting that tension. We've pulled together insights, specific data points from the big names, Yahoo Finance, CNBC, Bloomberg.
Right.
And the clear starting point, the biggest mover right now, has to be the scale of this AI acceleration. Specifically that, blockbuster AMD OpenAI deal.
And the core question for you, the listeners, really, is this AI boom a genuine supercycle? Like a decade of solid growth ahead?
Or
are we maybe underestimating the risks? The geopolitical stuff, the U.S. shutdown, the French political crisis. Is the market maybe ignoring that too much? We kind of need to look at it through both lenses.
Okay, let's definitely unpack the AI momentum first then.
Yeah.
The news from AMD, Advanced Micro Devices, on Monday, October 6th.
Yeah.
It was just staggering.
Yeah.
This massive infrastructure partnership they announced with OpenAI, really setting up a challenge to NVIDIA.
And this isn't just like a standard purchase order. It's a huge commitment, foundational compute. AMD is lined up to supply OpenAI with up to 6 gigawatts of GPUs.
6 gigawatts?
Yeah, over several years. They're kicking off with their new MI450 chips. That's second half of 2026.
6 gigawatts. This sounds like a massive number, technically speaking. Can you maybe put that into context for us? What does that actually mean?
Sure. Think about it like the 6 gigawatts. That's roughly enough power, enough compute to run a medium-sized American city for an entire year.
Wow.
So yeah, it's not just ordering some chips. This is industrial scale. It's like building a parallel AI ecosystem to really compete head-on with NVIDIA's dominance. It just shows the sheer scale needed for these next-gen large language models.
And the financial structure they set up is, it's just as interesting, maybe even more telling. AMD issued warrants to OpenAI.
That's right. Allowing OpenAI to potentially acquire up to 10% of AMD, that works out to about 160 million shares.
Okay, 10%. And how does that work?
Well, the shares vest in stages. It's tied to AMD hitting specific deployment milestones. So it starts when they deliver that first gigawatt.
An equity stake. Why do that? What's the strategy there?
That's the key insight, I think. AMD is basically giving OpenAI skin in the game. It's risk sharing, but also reward sharing.
Right.
It locks in this absolutely massive critical customer for potentially a decade.
Yeah.
OpenAI isn't just buying stuff anymore. They're a strategic partner, directly incentivized by AMD actually succeeding.
And the market obviously loved that signal. AMD
Yeah.
shares, what was it? They closed up 23.71% on Monday. Just incredible.
Yeah, a huge jump. It really fueled the broader index records, too.
That reaction definitely shows the confidence being projected. Yahoo Finance got comments from AMD's CEO, Lisa Su. She kind of brushed off the critics worried about AI spending getting ahead of reality, said they're thinking too small.
Yeah, she's framing this as the start of something huge. A 10-year kind of super cycle is the phrase she used. Something that'll transform basically every major industry.
And analysts are putting some really big numbers on that vision already.
Oh, absolutely. Barclays analyst Tom O'Malley, he crunched the numbers. He estimates this deal alone could add something like $18 billion in annual revenue for AMD by 2030.
$18 billion annually.
Yeah. And maybe $3 per share in quarterly EPS. That's not just growth. That's transformative.
And you're seeing ripple effects too, right? Like it's boosting the whole ecosystem.
Exactly. Citi's analyst Atif Malik pointed this out. It's good news for crucial suppliers, companies like Astera Labs, that's ALB. They provide the networking tech for AMD's Helios platform.
So the tide lifts more than just AMD's boat.
Right. Which brings us to this interesting structure emerging in the tech economy. CNBC had a piece calling it the Band of Brothers.
The Band of Brothers. What's that mean?
It describes this really interconnected ecosystem. You've got compute power, capital, equity, all sort of orbiting among just a handful of these big players. NVIDIA, Oracle, Broadcom, and now AMD and OpenAI are right in the thick of it.
It is pretty amazing how circular the money seems to be.
Yeah.
Like this 10% equity deal comes after NVIDIA's own huge, $100 billion pact with OpenAI.
Yep. And NVIDIA also put $5 billion into Intel, remember, to co-develop data centers.
Right. It feels less like a traditional open market, more like I don't know, a giant shared infrastructure project funded by a few key players.
But, not everyone's completely sold on this narrative yet. Investor Brad Gerstner, he offered a bit of caution.
Okay, what do you say?
He basically reminded everyone that these are just announcements, not deployments. Big difference. He stressed it's still a very high-stakes arms race, and ultimately, the best chips will win. Performance still matters most.
That raises the competitive question directly. Jim Cramer weighed in on CNBC. He argued this AMD deal makes OpenAI way more powerful.
Right.
He said the traditional hyperscalers, the big cloud guys like Meta, Google, Amazon, Microsoft, even Tesla, they should be right to be afraid.
Afraid why?
Because they basically have to keep pouring billions into their own AI infrastructure just to try and keep pace with OpenAI as it pushes into their verticals.
So you've got two views there. Gerstner saying, hold on, execution is everything. And Kramer saying, nope, the competitive landscape just shifted massively towards OpenAI.
Yeah. The takeaway for you, the listener, seems to be that this whole supercycle idea hinges less on the press release and more on whether AMD can actually deliver those 6 gigawatts of high-performing chips on schedule.
Execution risk is still very real.
And just one more point on OpenAI's sheer influence right now. Bloomberg called it the golden touch. We saw other stocks moving just because of an association. Figma shares jumped, 7.4%?
Just because CEO Sam Altman showed a demo on stage integrating with ChatGPT.
Exactly. That's pure momentum, driven by name recognition alone.
Okay, so if this AI world is so heavily capitalized, so concentrated, this band of brothers, what happens when the wider system, the external market, starts to wobble?
Right, that tension brings us straight to the other side of the coin. The chaos brewing globally.
We're seeing some pretty significant macro headwinds, mostly driven by politics right now. First off, here in the U.S., the government shutdown, it's dragging into week 2, still no clear end in sight.
And the problem isn't just, parks being closed.
No, not at all. The big issue for markets is the economic data blackout. Key reports, like the September jobs report, they're delayed.
Which leaves the Fed flying blind, essentially.
Pretty much. It makes it incredibly difficult for the Federal Reserve to get an accurate read on the economy right when they need it most for interest rate decisions. It raises the risk they make a mistake or just delay normalizing policy longer than needed.
And adding to that uncertainty, we had that sudden political shock out of Europe, France.
Yeah, markets definitely got rattled by the surprise resignation of the French Prime Minister, Sébastien Lecornu.
After only 27 days in office.
Exactly. He couldn't get consensus on the budget, spending cuts. It just resurfaced all these underlying fiscal worries across the Eurozone.
So when you get that kind of deep political and fiscal worry hitting major economies, the U.S. and France, what do investors do?
They run for cover,
Yeah.
straight into perceived safe haven assets.
And we saw that play out perfectly with gold. Prices hit another record high, pushed really close to $4,000 an ounce, hit $3,977.44 yesterday.
And what's driving that gold surge? It's partly central banks buying the People's Bank of China, notably kept up its buying streak.
Okay.
But it's also just anticipation. Investors betting that the Fed will eventually have to cut rates whenever that happens, given all this uncertainty.
The outlook seems strong, too. Goldman Sachs, they actually raised their 2026 forecast for gold.
They did, to a pretty staggering $4,900 an ounce. That signals some serious long-term hedging against risk.
This flight to safety idea also connects with resource nationalism, right? Governments getting nervous about supply chains.
Definitely. Look at the U.S. government's move with Trilogy Metals. They announced a strategic investment, $35.6 million, for a 10% stake in this Canadian minerals explorer.
And Trilogy operates where?
In Alaska. This is purely about securing domestic supply chains for critical minerals, copper, cobalt, zinc, stuff needed for the energy transition for defense.
Shows the urgency.
Absolutely. And the market got the message loud and clear. Trilogy Metals shares went parabolic, soared up to 205% in pre-market trading after that news.
Now, this focus on securing domestic minerals, it kind of contrasts with the broader global trade picture from the World Bank, doesn't it? Especially regarding U.S. policy impacts.
It does. It's fascinating. The World Bank actually raised its 2025 GDP forecast for China to 4.8%.
Despite those hefty U.S. tariffs, were they now like 57%?
Yeah, around 57.6%. The key insight, according to the World Bank analysis, is that China's managed to offset that drag. They've aggressively shifted their exports away from the U.S. towards other markets, mainly Europe and Southeast Asia. Their manufacturing base is just that diversified.
But it's not the same story everywhere.
No, definitely not. The World Bank cut the outlook for South Asia quite significantly, and they specifically cited punishing U.S. tariffs on India.
Which are around 50% on key exports.
Right, things like textiles, jewelry, very labor-intensive sectors for India. So it really shows how these U.S. trade policies are having a very selective, sometimes severe impact, disrupting specific markets quite badly while others find ways to navigate around them.
Okay, let's pivot back to individual companies, because regulatory risk is suddenly a huge theme, especially in ad tech.
Yeah, you're talking about Applevin, stock symbol APP. Its shares took a big hit, down as much as 14%.
Why the plunge?
Bloomberg reported that the SEC is investigating the company. The focus is on their data collection practices and whether they violated agreements about targeted advertising.
What triggered the investigation?
It seems to follow a whistleblower complaint, plus reports from several short seller firms like Muddy Waters and Fuzzy Panda,
And the core allegation is?
that Applevin software, called Axon, was systematically breaking App Store rules. Basically, extracting private user IDs without consent to feed their targeted ad engine.
Wow, that sounds serious, especially for a company just added to the S&P 500.
Exactly. The implications for the whole ad tech industry are pretty significant. This probe could set a major precedent for how the SEC balances privacy compliance against, aggressive growth tactics.
Okay, shifting gears completely to video games. We saw scarcity becoming a big theme there. Jim Cramer made a bullish call on Take-Two Interactive TTWO.
He did. His main argument is about real scarcity value.
Meaning?
Well, think about it. Microsoft bought Activision Blizzard, and then Electronic Arts, EA, was taken private in that massive $55 billion deal involving the Saudi PIF and others.
Right.
So Take-Two is now basically the only major publicly traded pure-play American video game company left.
That makes sense. Scarcity value.
And that scarcity is combined with the huge anticipation for Grand Theft Auto VI. It's slated for May 2026.
Still a ways off, and always potential for delays with GTA games.
Cramer acknowledges that. He actually advises investors to view any potential delays as buying opportunities. He sees it as a temporary blip in this longer-term scarcity story.
Interesting take. And just one more quick corporate story, emerging markets showing strength.
Yeah, specifically India. LG Electronics India kicked off the bidding for its $1.3 billion IPO. That's set to be the biggest listing ever for a home appliance maker there.
And the valuation looks pretty high.
It does, around 38 times trailing earnings compared to the parent company in Korea, maybe 14 times. But the strong demand signals just how much local liquidity and investor confidence there is in India's consumer story right now.
Okay, so this brings us right back around to the big challenge for investors in this market. How do you balance all this? The incredible AI hype, these massive valuations, but also the very real geopolitical fear.
It's the central dilemma. And legendary investor Peter Lynch actually weighed in recently, offering a kind of grounding perspective.
What did Lynch have to say? He managed the Magellan Fund so successfully for years.
He really did. He brought a dose of classic Lynch realism to the tech boom. He said flat out he holds zero AI stock.
Zero. Wow.
Yeah. And he admitted, kind of humorously, he literally couldn't pronounce NVIDIA until about 8 months ago.
Huh. That definitely makes his point.
It underlines his core investment role, the one he's always championed. Know what you own. If you, the investor, can't really explain the technology, the business model, the competitive edge, then you're not investing, you're speculating.
A timeless piece of advice.
But here's the balance Lynch also offered. He warned against automatically dismissing ideas just because they've already run up a lot. He cautioned against trying to play the market.
Right.
He used McDonald's as an example, noting that sometimes you don't have to be in the first inning to still capture enormous long-term gains like their whole international expansion phase.
So it's not necessarily about being first, but about understanding. Yet there's still that fear of missing out on a potential supercycle.
Exactly. And adding fuel to that fire is someone like hedge fund manager Paul Tudor Jones. He believes all the ingredients are there for one last powerful surge in this bull market before a major blow-off top.
Like the end of the dot-com boom.
That's the comparison he's drawing, a potentially explosive final phase.
So the market really is living in these two parallel realities right now.
It absolutely is. You've got the AM Dope and AI deal reality, sending chip stocks to the moon on this promise of a decade-long AI revolution.
And then you have the reality defined by global friction, the U.S. shutdown, the French crisis, gold surging, Applevin facing the SEC.
Yeah, all that instability.
So the final takeaway, the question for you, the listener, the prudent investor, is really this. Given all the AI excitement, and Paul Tudor Jones warning about a potential blow-off top. How do you square that? How do you reconcile the pressure to participate in what might be a 10-year supercycle with Peter Lynch's fundamental rule of only investing in what you truly understand?
Which principle guides your decisions right now? That's the defining tension of the market in late 2025.
It certainly is. Well, thank you for joining us for this deep dive today. We appreciate you tuning in, and we'll see you all tomorrow morning with new headlines from major financial magazines.